Well, the markets erased last week's losses, ended at a one-month high. Who would have guessed that, right? The Nifty closed above 22,000 for the first time in the last 1 month. Financials led the rally and the Nifty Bank ended over 2% higher for the week. On Editors Roundtable today, we speak about the big weight changes on the Nifty over the last 1 year. We also try to compare HDFC Bank and SBI to find out whose year it is. I'm Sonia Shenoy and today with me are the editors Anuj, Prashant, Nigel, Nimesh. We also have Mahesh Patil of Aditya Birla Sun Life AMC who's here with us. Mahesh, thank you so much for joining us in the studio. But folks, it's interesting, right? Very, very interesting week. But the bulls fought and fought hard and kind of came out winners.
Absolutely. And first of all, we have a full house. I think we missed you last week, Sonia, of course. But I think this was a good week for the market because this was the week in which the market had that acid test. That big fall in the US market, that inflation scare, everyone almost feeling that okay, this is it. This is really that moment, and the market just made a mockery of that day itself and closed at a day's high. I think it was clear when you have the bad news being bought into, that's a big positive for the market.
Oh, absolutely.
I just want to say one thing, and I don't know if you guys agree with it, especially in the US, right? Anuj, I don't know, actually it's before our time as well. I mean, we started in the early 2000s. Maybe Mahesh will remember this. When the Dow hit 10,000 in the US, the mayor of New York, it was Rudy Giuliani, he actually went out and wore a hat which said Dow at 10,000. And after that, we did not see that level for the next 6 or 7 years or so. It's on YouTube. I recently watched the video.
It happened with me.
It happened to us also when the Sensex hit 20,000. We wore a T-shirt, and after that, for many years, I don't think we saw that level again. Here we are.
That's the peak of euphoria, right? I mean, everything is right.
So I was asking that question. Actually, essentially in the US, in the context of the US, are we? At a moment like this, because it just looks very, very nice. And
I guess a lot of things is because a lot of things are happening for the first time. I think we just don't know that something like this can exist. For example, this mid-cap overvaluation we've been talking about for 6 months. We have seen in between 2 Kotak reports, right? Both talking about. And since the last report, the index is up some 40%.
Last one was called Mad Caps, and today I think there was a report. Only greed, no fear. Fear, greed.
But now I think even from the sell side, see, we normally talk about FOMO feeling from an investor point of view. Look at the brokerage notes now. Today, there is a big upgrade on OMCs. Jeffrey is putting out a note on BPCL with a target price of 890. Despite the fact that BPCL has been the biggest outperformer in the index in this year, right? I mean, that's the kind of FOMO now among the sell side as well. So. And this is all domestic.
So FOMO in brokerages also now.
FOMO in brokerages also.
Actually, that call says more about the analyst rather than the stock. Because the price target was 500 something. It went straight to 800 something because that was a double upgrade or whatever.
I think before we go to more serious stuff, just no hats, no t-shirts. We'll be fine from our Come on, make your point.
I just think PSUs have been the biggest revolution, right? Because we have a PSU fund, right? Incidentally, I mean, the 1 year return is 100%, right? I mean, after that, nobody would have thought, right, a year back. So I think that kind of, there's definitely been a transformation, what we've seen in some of the PSUs, but the re-rating has been humongous. So I think last 1 year, we saw large, big moves. If you look at last calendar year, big thematic moves which were there, whether it's in the capital goods sector, the PSUs, to some extent in the auto sector, real estate. I think probably now, this year, I think you should see some amount of normalization. I don't think there's any pocket left where you can see those outsized returns in the market.
But how are you feeling about the market in general? Is this a time to raise cash levels? Is it time to get cautious? Or you think that the going will still be good?
So I think as a fund manager, I mean, when things move up so fast and so quick, right? And always you're a bit cautious because you always want to buy at the right price, right? But having said that, I think the good thing is that the outlook across, I mean, I don't find, except for a few sectors, the outlook in most of the sectors is fairly good. Right, except probably for consumer discretionary, okay, where we are still seeing some kind of a slowdown in consumer staples. Otherwise, investments, again, picking up. We're seeing the pharma sector, right, doing well. Even IT sector, right, where global fears, okay, are a concern. We're seeing things kind of bottoming out over there. So I would say, in certain pockets, obviously, there is over-exuberance. So one is a bit cautious, and that's, I think, echoed by most of the fund managers. And we talked about mid-cap, small-cap, right? I mean, obviously, when your returns are ahead of your earnings, right, that's what you have seen in the mid-cap and small-cap. In the last 2 years, if you look at the returns in mid-caps and small-cap, 50% is because of earnings growth and 50% is because of PE rating. in the large cap, there's a lot of comfort, right? I mean, while the large caps have also done well, its bulk of it is driven by earnings. So we haven't seen any kind of... So I think there is a lot of still comfort in the market, right? There are a lot of pockets where the valuations are still reasonable. Obviously, we had a very good run and in the outlook is good. So you'll always trade at a premium. You will not get something at a cheap.
You know, let me just quickly recap. You laid out the slightly longer term, medium to longer term. Let me just lay out for the week, essentially, what really happened and maybe a little bit looking ahead. So we are basically at new all-time highs. I mean, even at when the market fell, we were a few percentage points away. January, that pullback was very short-lived. Earlier this week, we had that one-day mid-cap scare, small-cap scare, but nothing. It's always been, the previous highs have been within sights, and it's become clearer now. The question only is, I mean, the high will happen, but is there a big, in this leg up, is there a big continued kind of run-up? That's essentially the question. Maybe there is, we'll find out. Momentum in PSUs continues. You know, bank index, CPSE index, PSE, energy, oil and gas, and there are 4-5 of these indices. I looked at Friday to Friday gains, they're all up 2.5% to 3%. By the way, the small cap index this week was down 0.5%, but the PSU indices, 2.5%, 3% higher. The question, and we'll sort of talk about this one in greater detail, you know, you got to have large cap stocks with sort of, you know, fuel in the tank, right? HDFC Bank, when I say fuel in the tank, I mean, room to rise, clear room to rise. HDFC Bank clearly is one of them. The question is, it stopped falling, but the pace, can it be faster? Because that's still a large weighted index with a big say in what the Nifty and Bank Nifties do. Global confusion, I think that continues. Is data hot? Is data good? Is good data good? Is bad data good? I think, you know, I think there's a big sort of talking point globally. People who look at macros, etc. By the way, it's an interesting fact. This year so far, YTD, rates markets have removed 70 basis points of cuts from their pricing in 2024. 70 basis points. We're in February. They've taken out 70 basis points worth of rate cuts in terms of what's priced in. The 10-year has moved up about 10 basis points on a week-on-week basis. So, you know, watch it. It's, you know, at about 4.2, 4.25%. But that could be the big cue as we look ahead as well.
Okay, well, lots happened in the Nifty, right? The Nifty has seen some massive weight changes over the last 1 year, with the most notable one being a drastic fall in HDFC Bank's weight. But who has filled that space? Anuj, you've done some data crunching for us?
You know, Sonia, you know, I'm a movie buff and I like to relate these things with movies. One of my favorite movies over the last decade has been Bahubali. And, you know, in that it says, Amrendra Bahubali nahi rahe, aapke naye Maharaj hai Mahendra Bahubali. So, you know, whose markets knew Bahubali? Because HDFC Bank, of course, was that big Bahubali. But it's changing a bit now. Now, what I'm doing is I'm comparing the data from June 2023. You asked me why I picked June 2023, because the HDFC Bank-HDFC merger became applicable from July 2023. So, in June 2023, the combined weight of HDFC and HDFC Bank was at 15%, and Reliance was a distant second at 10%. And 5% was a big gap. Look at what it is now. And it's not as if Reliance has done something great. Though, to be fair to Reliance, the Jio Financial has moved out, so that also has had an impact. But 11.6% weight for HDFC Bank and 10.2% weight for Reliance. So the distance is now getting narrower. Now, who has filled that space? You would think that it's ICICI Bank, but it's not. ICICI Bank's weight actually 7.74% has fallen to 7.6%. That's because while ICICI Bank as a stock has not fallen a lot, it's also not risen a lot as well. But these are the stocks which have filled in. Infosys from 5.64% to 6.24%, Larsen & Toubro from 3.54 to 4.33, Bharti Airtel from 2.6 to 3.2, and Tata Motors. And these two really have been the big outperformers. Their weight to start with was quite low, but in absolute terms, they've actually gained quite a bit. Tata Motors from 1.2% has gone up to 1.6%. So what HDFC Bank has lost, actually a lot of other stocks have filled in. Now look at it sector-wise. Banking was 38% last year. It's fallen to 32%. Again, you ask, which are the sectors which have filled in that space? Some to autos from 4.5% to 6%. Some to metals, and in metals, a large part of this is Coal India, which also gets categorized in metals, from 3.5% to 5%. Power, which is essentially NTPC and Power Grid, from 2% to 3%. And telecom, which is essentially just one stock, Bharti Airtel, 2% to 3%. That's been the weight changes. And finally, I am looking at the index sectors, and within that, what's the price to book value versus average, it will surprise you that IT has actually now become the most expensive once again after the big rally that we have seen, because the numbers have not been supported, but the stocks have rallied. So IT is actually 153% of its own average. Autos, after that big rally, though in autos, the earnings have been supportive, but because the stocks have risen so much that it's still 126% versus average. Banking actually is a sector where you have some valuation comfort. Now it's trading at average valuations. Consumer also has gone up a lot, 142%. Large part of this is because earnings have not kept pace. And chemicals, of course, 41% looks cheap, but let me add here, because it's only one chemical stock which is there on the index, that's UPL. So net, HDFC Bank has lost out, but the market has broadened. That's been the key takeaway.
Okay, Mahesh, I wanted your thoughts on this. What do you do with HDFC Bank? You know, I just did a discussion with Gautam Dugad of Motilal Oswal a while back, and he said that this is perhaps the best time to buy HDFC Bank when everyone is fearful. Would you concur with that view?
Well, I wouldn't talk on stock specific,
Sure.
but by and large, if you look at the banking sector,
Private banks.
private banks in general, right?
Banks, because there's been a big dichotomy between private banks and PSU banks.
So what has happened is, if you look at one of the factors, okay, which is driven that is, if you look at FIs, right, in the last 20 years or so, they would have totally bought around, say, around $250 billion of stock, right, which value would be around, say, $650 billion or so. And bulk of that has gone to financials and consumers. And we've seen that overweight, okay, which has been there, there's some unwind which is happening. Again, it could also be because of company-specific issues, but that large overweight in the sector is what the technical reason, but we are seeing some of the pressure, okay, in the private banks. Obviously, wherever there are management changes, okay, we've seen the premium which was there earlier for a particular management, I think that to some extent has gone on. But I think clearly, I think if there's a divergence between the fundamentals, right, and the stock price movement, I think beyond a point it can't sustain. I mean, the divergence at some point in the time has to break. So I would say that in the private banks, if you look at the numbers itself, right, have been fairly steady. Yeah. I mean, there is some pressure on deposit side, right, because of the whole tight liquidity in the system and LDR issue, but I think the numbers have been fairly decent. On the other hand, I think PSU banks have shown spectacular numbers. Again, they are not as much constrained on the loan to deposit ratio. So there is some amount of movement. I think we always see these mean reversion trades, right? They came to normalize, and probably it's time for private banks to start, okay, when everybody is given up on them, you could see them probably surprising on the positive.
It's such an interesting time, right? Everything that has not worked for the last 10 years is working now.
Right.
Defense, PSUs, railways, and everything that has worked for the last maybe 20 years has now stopped working. So it's very interesting, right, how the market is moving. But Anuj just pointed out that HDFC Bank's weightage on the Nifty has come down. Nigel, you're looking at what's worked for SBI versus HDFC Bank.
Well, whose years is it going to belong to? 2024, will it go to SBI or HDFC Bank? For the time being, we've seen by the stock price that HDFC is lagging, while SBI has been out of the blocks in style, and the stock price is telling you that. And post this underperformance, HDFC Bank relatively has become a little cheaper, while SBI, well, it's re-rated to some extent, but there's still a big valuation gap between the two. And what's common between them first up? The ROE and the loan growth, as of now, is similar for both of them. And this is the first time in the last 12 years that we've seen HDFC Bank and SBI have a similar ROE as well as a loan growth. But what gives SBI the edge, at least as of now? Well, one factor is the CASA of SBI is nearly 1,000 basis points higher in comparison to HDFC Bank. Remember, post the merger, there was a big dilution for HDFC Bank's CASA, and that explains why there's a big gap right now. The cost of deposits across 10 years as well for HDFC Bank is nearly 0.25% higher in comparison to SBI. So they're going out there, they're trying to get deposits, but it's going to come at a higher cost as well. Next up, SBI is more skewed. Now, their book is more skewed towards the corporate sector, which isn't such a bad thing. Close to 45% of their book is towards the corporate sector, which may be good in current environment. And also, if you look across mutual funds, there's a higher weightage that's given to HDFC Bank. You could attribute it to hugging of the index or maybe replicating of the index. And that's why SBI is still under-owned across mutual funds. And finally, you get a little bit skeptical, right? PSU banking names, they go ahead and they revise their wages. And that sometimes throws up a shocker. But most of that will be done in FY24 itself. Some part of that was seen in Q3, and most of that will be seen in Q4. So there won't be any shocker that will come about. So 2024, who is it going to belong to? HDFC Bank could be relatively cheaper in comparison to its historical averages, but SBI has got the momentum. So can it drive the advantage home?
Nigel, thanks very much for that. And guys, I was talking to a senior banker, Mahesh, who spent some time at HDFC Bank, and maybe a slightly biased view, but he was saying that you know, for example, Amitabh Chaudhary was on our program 3 days back, and I was talking to Lata, and he was saying that the best of the credit cost cycle is behind. Credit cost will rise. It's impossible for credit cost to be 0.3%, 0.4%, so it will rise. And his point was that, aap dekho, jab credit cost cycle turns, and it will turn in the next 6 months, then our underwriting skills will show. HDFC Bank's, you know, ability to lend in a way, you know, see problems 2 years ahead, start to reduce exposure, all of those things which, you know, public sector banks are not known to do. You know, because this is, in a way, the first cycle where they're all being recognized for better governance and, you know, all of those things, but they've not seen, you know, they suffered in the last crisis, but they've not seen an up cycle and then a down cycle in that sense. So,
yeah,
we'll
so
see.
that's why the piece was, whose year is it going to be?
No, it could be SBI. So this is not to say that SBI maybe does, you know, equally good or even better, but maybe, you know, the case for HDFC as well.
If this is what 2003 to 7 repeat of 2003 to 7 phase was, I don't know if you remember, SBI was really the big outperformer in that period. Though of course, over a 20-year period, HDFC Bank has been HDFC Bank. So let's see, we'll find out.
Indeed, and the ROE and the loan growth, you know, the first time in 12 years that they're matched to SBI. So that's the first time.
And as a retail investor, you can buy both, right? You can have an exposure to both. You don't have to buy either or. Okay, let's do one thing. Let's take a quick commercial break on that note. On the other side, we will see which stocks are seeing promoter selling. We'll also discuss more about the markets with Mahesh Patil in just a bit. Stay tuned.